Today, we will learn to trade rallying markets with full top-down analysis. However, I will also teach you an alternative and relaxed way of trading for all the beginner traders. If you are ready, let's do this. I was getting a lot of questions about liquidity and how to really understand it and actually master it in trading. So I decided to make a video that is 100% focused on the liquidity and nothing else. First of all, in my opinion, finding and understanding liquidity areas depends heavily on the current trend and the overall momentum. As you know, I'm a big fan of following the general trend and when it comes to trading in the markets. The first thing you should always want to look for is price taking out the prior old highs or not. Because this is a big sign of strength, clear trend direction, and real power in the markets. Naturally, traders like all of us want to follow the trend and keep entering trades with the same momentum. However, as more traders enter, the number of positions keep increasing. This creates a lot of open stop losses in the market. Over time, you will start to notice a pool of stop losses building up around certain specific price levels. This is a moment when liquidity pools are created in the market. These areas usually consist of thousands of stop losses sitting in the same zone from traders all around the world. At some point, those stop losses are usually swept, and then the general trend continues to flow in the main direction again. It does not matter whether the market is rallying or crashing. The core idea stays the same in every market condition. As traders, we like to follow momentum and trade in the direction of the overall trend. This is because statistically, following the trend tends to make more money than trying to trade against it. But that does not mean we can enter trades at just any random point. We need to be aware of liquidity pools where thousands of stop losses are stacked and gathering in specific areas. We also need to understand that liquidity pools can be created and swept at any moment. As I said before, following the prior highs and lows and knowing which side is getting taken out is critical for understanding the trends. The problem is that no trend or momentum lasts in the same direction forever. At some point, even if you see a liquidity pool get swept, it does not automatically mean the trend will continue. After that, you may start to notice internal breaks forming in the opposite direction after or with a major break. So this can often be the point where the trend reversal begins. So let's look at this example. On this chart, you can see a big major break that was taken out earlier. Many traders want to follow the direction of new upward move, which is a very natural reaction. However, all of these newly opened trades, sometimes thousands of them from all over the world, creates a heavy concentration of stop loss orders in the similar price levels as you can see. In many cases, this behavior is followed by a large and deep liquidity sweeps. After that, the price action often shows internal breaks again, leading to a second, third, or even fourth of the main rally. So as you can see, understanding liquidity and where it gathers is extremely important. Using this information in the direction of the trend can be a strong and effective strategy for most traders out there. Okay people, this is it for today. Please take care and see you in the next video. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free trading view indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.